For years, the marketing hook of copy trading was simple. Attach your account to a pro, step back, and watch the passive income roll in. The reality of that early era was a lot less glamorous. Followers routinely woke up to entirely wiped out accounts, devastated by influencer traders gambling with other people's money. Look at this split chart. On the left, a red line spikes 500% before plummeting to zero. On the right, steady growth. Today, MiFID III regulation shifts this. Providers must prove 24 months of verified data before touching capital. Navigating this professionalized landscape requires acting as a manager of managers. It means performing deep dive due diligence on every provider before allocating a single dollar of capital. Surviving in this ecosystem requires abandoning old leaderboard rankings entirely. Your capital protection depends on adopting institutional vetting standards. The fastest way to destroy your portfolio is selecting a provider based purely on top-line returns. A trader boasting a 500% gain is often just one bad trade away from zero. We see a steady, upward staircase of profits, but an AI scanner reveals massive hidden drawdown spikes beneath every step. This is a martingale strategy, doubling down on losing positions. It creates the illusion of wins, but mathematically guarantees a total account wipeout. Professional platforms today use machine learning models to see right through that trap. They analyze the actual risk DNA of a trader's history, flagging desperate moves like widened stop losses or suddenly increased lot sizes. Instead of raw profit, evaluate this specific metric, the recovery factor. You calculate it by dividing the trader's net profit by their maximum drawdown. A score above 3.0, like the one shown here over a clean sparkline, indicates a professional handling risk correctly. AI vetting ensures the provider isn't suffering from style drift. You need proof they rely on a sustainable, logical price action framework, rather than throwing indicators at the wall and hoping to get lucky. The trade-off here is straightforward. You accept lower, less flashy monthly returns. In exchange, your portfolio actually survives when the next black swan event hits the market. Let's say you find the perfect, highly vetted trader. They close a trade for a 10-pip profit. You check your account and you actually took a loss. Where did the money go? A trade signal leaves the London node, travels to the platform, and hits your broker. Delay at each jump creates the slippage gap. A 1.5 pip delay costs you 40% of potential profit. Compounded over 100 trades, it bleeds your account dry. The structural fix for intermediate traders is insisting on same server execution. By committing your capital to a unified, low-latency broker ecosystem, you eliminate those network jumps. The execution happens instantly, aligning your entry price directly with the masters. Even the most brilliant, tightly risk-managed trading strategy is entirely worthless if your server infrastructure introduces too much friction. Execution speed dictates your survival. Beyond execution speed, you have to verify compensation models. Exactly how your signal provider gets paid dictates exactly how they will treat the follower's money. Legacy platforms often compensated providers through spread markups or volume-based rebates. This is a massive hidden liability. Spread markups incentivize churning. The provider opens useless trades to collect commission, leaving your equity flat. Under the high watermark structure, they only earn a fee when pushing your account to a new all-time high. Their financial interests become identical to your own. Insisting on strict structural fee alignment is the verified way to protect your portfolio from internal sabotage by the people you hired to manage it. The final step in 2026 is moving entirely past the single master trader. You need to construct a diversified multi-asset allocation. Human discretionary traders excel in specific environments. You deploy them to navigate high-impact macroeconomic news, rapidly shifting sentiment, and central bank pivots. But humans need to sleep. Algorithmic quant bots execute statistical arbitrage and mean reversion with flawless mathematical precision during low volatility sessions. By combining these two distinct operational styles into a hybrid portfolio, you naturally hedge against varying market conditions and smooth out your overall equity curve. To secure that hybrid portfolio, you apply platform-level fail-safes. Notice this switch for hard equity protection. It's an automated kill switch that instantly disconnects your account from any provider if a strict 15% drawdown limit is breached. Proactively mixing asset styles while enforcing uncompromising automated risk limits separates the passive gambler from the active portfolio allocator. Professional social trading is a highly disciplined operation. You act as the manager of managers. This quadrant chart maps the landscape. Seeking zero-effort wealth leaves you vulnerable to scams. This red zone represents the passive gambler, the dangerous illusion of legacy copy trading. Up here is the 2026 FXNX standard, active management paired with capital protection. This standard is built for the intermediate investor willing to trade their time to audit performance metrics and enforce institutional-grade execution environments. It requires a complete shift in your evaluation process. Stop looking at the top-line ROI column and start interrogating the underlying risk DNA. Download the 2026 Social Trading Due Diligence Checklist. Use the FXNX platform tools to audit your current signal providers right now. Sustainable profitability requires 3 things: high-integrity vetting, low-latency execution, and aligned fee structures. Build your portfolio on those pillars.